dividend income, stable growth, and long-term wealth. That is why I am buying SCHD in 2025. Welcome to Asset Index, where we help you navigate wealth with data, not hype. Today I am breaking down the SCHD ETF, why it is becoming one of the most popular dividend ETFs and why I am personally buying more this year. Part 1. What is SCHD? SCHD stands for the Schwab U.S. Dividend Equity ETF. It tracks an index of high-quality U.S. companies with a strong history of paying and growing dividends. These companies are screened based on 4 key factors: dividend yield, dividend growth, return on equity, and cash flow to debt ratio. Translation: you are getting a portfolio of companies that are financially solid and shareholder-friendly. Part 2. What does SCHD hold? As of early 2025, top holdings in SCHD include Broadcom, Cisco, Verizon, Texas Instruments, Pfizer, Coca-Cola, and Amgen. These are not hyped-up tech stocks. They are steady businesses that pay out consistent income even during rough markets. Part 3. Dividend power. This is where SCHD really shines. It currently yields around 3.5 to 4% annually, and the dividend has grown almost every year since launch. In fact, from 2020 to 2024, SCHD's dividend payout grew by over 30%. That means you are not just getting income, you are getting growing income. Part 4. Performance. Let's talk returns. Over the past 10 years, SCHD has returned around 10 to 11% annually. That is impressive for a dividend-focused fund. Even more impressive, it has done that with less volatility than the broader market. In other words, it gives you strong performance without the roller coaster ride. Part 5. Why I am buying in 2025. Reason 1. Market uncertainty with interest rates, inflation, and tech stock volatility. I want to own assets that generate reliable cash flow. SCHD gives me that reason. 2. Dividend reinvestment. By automatically reinvesting dividends, I can compound my returns over time and accelerate wealth growth even faster. Reason 3. Tax efficiency. Dividends in SCHD are qualified. That means lower tax rates for most investors and fewer surprise capital gains compared to active funds. Reason 4. It fits my barbell strategy. I pair SCHD with growth-focused ETFs like VTI. That way I get both stability and upside, without overexposure to hype. Part 6. Common misconceptions. Some say dividend stocks underperform growth stocks, or SCHD is too old school. But here is the truth. Over long periods, dividend-paying companies tend to outperform because they are profitable, disciplined, and focused on real value. SCHD is not flashy, but that is exactly why I like it. Final thoughts. SCHD is not a get-rich-quick ETF. It is a long-term income and growth machine. If you are serious about building wealth and want a core holding that pays you to hold it, SCHD should absolutely be on your radar. I am not just watching it, I am buying it. Subscribe to Asset Index for more weekly ETF breakdowns, long-term investing strategies, and wealth-building content that actually works. Coming up next, my full breakdown of JEPI versus SCHD, which income ETF wins in 2025.